September 16, 2008. New York. A portfolio manager, call him the desk, holds gold at $900 an ounce. Lehman has just filed. The crisis he bought gold to hedge against has arrived. He sells every ounce anyway. Not because he is wrong about gold, because his mortgage book is collapsing, and gold is the only thing liquid enough to meet the margin call arriving in 4 hours. Gold drops 30% inside 6 weeks. The crisis it was bought to hedge is still getting worse. This is not fiction. This was New York, 2008. That inversion is the whole video. Gold's sharpest sell-offs often happen at the exact moment the thing it exists to hedge is getting worse, not better. And if you read that drop as a bearish verdict on gold itself, you are usually reading the wrong document. Because a gold crash is often not a statement of belief, it is a statement of constraint. The World Gold Council, in its 2019 retrospective on the global financial crisis, documented a roughly 30% peak-to-trough decline during the 2008 panic, even as systemic stress deepened. That matters, because it tells you the price break and the macro danger were moving in opposite directions. So what was the market actually saying? Not gold failed, something else failed first. And that is the fingerprint you need to learn to see. In 2008, the seller was not a calm long-term allocator changing his mind about monetary risk. The seller was trapped, leveraged, time-boxed, forced to raise dollars from the one asset that still had a bid. Stay with me, because once you identify the seller, every major gold correction starts to look less like a referendum on the metal and more like an X-ray of the system unloading it. Here is the part most people miss. In a real panic, the best hedge in your book can become the first asset you sell, not because it failed, because it worked. That was the 2008 mechanism, and it was brutally simple. The mortgage book breaks first. The bid disappears. Mark-to-market losses hit. Prime brokers want collateral. They want it now, not next week, not after a committee call. By the end of the day. And the poisoned assets cannot save you. Mortgage-backed securities were the problem. They were also suddenly hard to move at any price that would close the hole. So the institution looks across the book for something else, something liquid, something profitable, something that still trades clean. Gold. Keeney Financial's 2025 reconstruction, drawing on World Gold Council data, lays out the sequence plainly. Illiquid loss, margin call, liquidation of liquid winners, dollar spike, deeper pressure on gold. That sequence matters more than any headline from the period, because the sell signal is coming from the wrong asset class. The trade in gold was correct. The funding structure around it was not, and that difference is everything. If you were on that desk in New York in September and October 2008, you were not asking, has gold lost its monetary function? You were asking a much uglier question. What can I sell in the next 4 hours? That is not investment analysis. That is triage. CNBC's contemporaneous coverage in September and October 2008 captured exactly that atmosphere. Funds and institutions scrambling for cash, selling what they could rather than what they wanted. The dollar surged. Gold dropped. And to anyone watching price without context, the message looked backwards. Danger up. Gold down. Wrong conclusion, because the fall was not a vote against gold as insurance. It was proof that the fire had spread into the funding pipes. Here's the operational rule. When a hedge falls during a systemic break, the first question is not whether the hedge failed. The first question is whether its owner failed somewhere else. Who got trapped first? The leveraged institution with cross-portfolio exposure, the fund that owned the right crisis asset inside the wrong balance sheet structure. The player who needed liquidity more than conviction. Who adapted first? Usually not the biggest fund, not the television strategist. The survivor is the holder who does not face forced liquidation on someone else's timetable, the one who can wait while the distressed seller cannot. That is the first fingerprint. A gold correction during acute stress is often a liquidation event disguised as information. Price looks like belief, but under pressure, price is often just collateral movement with a chart attached to it. And once you see that, 2008 stops looking like an exception. It starts looking like a template. Then the pattern breaks. Or rather, what you thought was the pattern breaks, because not every gold sell-off comes from distress. Some come from policy, deliberate policy, written down by named officials in dated memos with institutional signatures attached. This is the buried mechanism most viewers never hear. In 1975, Arthur Burns was chairman of the Federal Reserve, and in a June 3, 1975 memo to President Gerald Ford, preserved in the Ford Presidential Library and echoed in the Foreign Relations of the United States record, Burns argued that rising gold prices threatened confidence in official monetary arrangements. That was the fear. Not jewelry demand, not retail speculation, monetary credibility. So what did they do? Burns had already been in communication with Bundesbank President Karl Clausen. A November 14, 1973 record confirms the basic understanding. Germany would not buy gold above the old official price of $42. 22 an ounce even, while the market price was already trading around $160 to $175. Read that again. The real market was saying one thing. The monetary authorities were trying to preserve another number entirely. Two prices, two realities, and then came the auctions. Beginning in 1976, the IMF sold roughly 25 million ounces into the market. Gold, which had traded near $180, fell to about $130 by August 31, 1976. A savage correction. The kind of move that convinces late entrants they misunderstood the whole trade. But the forensic record says something colder. The seller was not panicked. The seller was official. That changes how you read the chart. A distress liquidation tells you the funding system's breaking. A policy liquidation tells you the monetary authorities think the price itself is politically dangerous. Not. Gold is weak. Gold is causing trouble. And the outcome matters, because the 1976 trough did not settle the argument. It delayed it. Gold later ran to roughly $850 by January 1980. From the engineered low, that was a multiple that turned a policy success into a historical failure. Here is the deeper lesson. If you only study gold corrections through the language of fear and greed, you miss the institutional motive. Sometimes the price is falling because leverage holders need dollars. Sometimes it is falling because officials need obedience from the price itself. Different trigger. Same viewer error. In both cases, people look at the falling chart and assume the metal has been discredited, but the chart is not always recording discredit. Sometimes it is recording coercion. And once you understand that, the seller's fingerprint gets sharper. Distress leaves one kind of trace. Policy leaves another. The 2026 break, when we get there, will show both shadows at once. Now bring that framework forward. January 30th, 2026. A policy shock hits the tape. Kevin Warsh is nominated as Federal Reserve Chair. Markets immediately start trading the implication. More hawkish, tighter for longer, less tolerance for inflation drift. CNBC's same-day coverage captured the speed of the move. Spot silver was down 28%. Gold was down 9%. Matt Maley at Miller Tabak looked at the tape and said the quiet part out loud. This looked like forced selling. Krishna Gulha at Evercore ISI framed it another way. The market was trading Warsh as hawkish. Different decade. Same fingerprint. A lot of people saw red candles and assumed the metals complex had just received a sober fundamental verdict from the market, but that interpretation was too clean. And clean interpretations are usually wrong in stressed conditions. Because what had happened in 2025, a long rally, big paper gains, leverage positioning, crowded conviction, then a shock to the expected policy path. Once that repricing started, the issue was not whether gold still mattered in a world of sticky inflation and institutional distrust. The issue was who had financed their exposure in a way that could survive a violent reset in rate expectations. Many had not, so the liquidation began. And once it begins, it feeds on structure, not logic. Stops hit. Risk models compress exposure. Prime brokers tighten terms. Winning positions are sold to plug holes open somewhere else. The chart starts looking like opinion. But under the hood, it is plumbing. That was January. Then March made it even clearer. On March 19, 2026, the WMC delivered a hawkish hold under Warsh against a backdrop of elevated energy prices and stubborn inflation. Brent was near $119 a barrel. Gold broke the $4,800 level. GLD fell sharply. SLV dropped harder. Reports across financial content and related market coverage describe the move in the language that matters: indiscriminate liquidation. That phrase is important. Indiscriminate means the market is no longer choosing carefully between strong hands and weak hands, between good assets and bad ones. It is selling whatever can be sold: mining shares, ETF exposure, silver, gold. Not because each instrument has been thoughtfully reevaluated, because collateral has to be raised. And when you compare that sequence with 2008, the rhyme is obvious. The trigger changed. Mortgage panic then. Fed regime shock now. But the inner mechanism did not change at all. A leveraged holder is forced to undo a correct trade to survive pressure created by another part of the book. That is the seller's fingerprint in modern form. Not a philosophical rejection of gold. A structural rejection of leverage. And that distinction decides whether you panic with the seller or study him. Now we get to the buried lead. The people selling gold in a correction are often not the people buying it through the correction. And that is why so many viewers misread the event. Because they see one chart, one price, one headline. They assume one market, but the forensic record shows two different populations operating under two different constraints. On one side, leveraged Western funds, macro desks, ETFs, and algorithmic traders, fast money, marked every day, vulnerable to margin calls, volatility limits, Vayur compression, and policy shocks. They sell because they must. On the other side, sovereign institutions, central banks, reserve managers, slower hands, different mandate, different time horizon. They buy because the correction improves the transfer price. That is not theory. The World Gold Council's October 2025 demand reporting showed central bank and investor demand around 980 tons in Q3 2025 alone, more than 50% above the prior four-quarter average. At the same time, major research desks were not describing this as the end of the gold story. J.P. Morgan's Natasha Kaneva and Gregory Shearer were projecting a path toward $5,000 by the fourth quarter of 2026, with $6,000 possible on a longer horizon. So ask the obvious question: if the smart money is selling, why are central banks still accumulating? Because the phrase smart money is doing too much work. A forced seller is not smart or dumb in that moment. He is constrained. He is liquidating under rules he did not write. The central bank buyer is operating under a different objective entirely: reserve diversification, geopolitical insulation, confidence hedging against fiat fragmentation. Different buyer, different war. HSBC analyst James Steele said the quiet part in October 2025, before the March 2026 break confirmed it. An equity correction could trigger long liquidation in gold as investors raise cash or meet margin calls. The Bank of England's Financial Policy Committee in April 2025 also warned about significant margin calls on hedge funds and the risk of further sharp corrections after tariff volatility. So the warning was on the record before the event. That matters because it tells you March 2026 was not some mysterious collapse in the gold thesis. It was a transfer mechanism. Metal and exposure moving from impatient, leveraged hands to deliberate, well-capitalized hands. And historically, that transfer has had a winner. Not immediately, but repeatedly. So what survives from this record? Not a prediction, a protocol. First, Identify the seller before you interpret the price. If gold is falling into a widening crisis, ask who needs dollars, who is getting margined, who is selling liquid winners to cover illiquid losses. Do not start with the chart. Start with the constraint. Second, separate paper exposure from usable wealth. A position that can be liquidated against you on someone else's timetable is not the same thing as reserve wealth held without leverage. Nominal ownership and durable control are not the same under stress. Third, watch for policy fingerprints. The 1975-76 break showed that officials can treat a rising gold price as a political problem. Not every sell-off is panic. Some are management. That matters because a managed decline can still reverse violently once the policy objective fails. And now, the numbers. Gold fell to roughly $720 in the October 2008 panic, and later reached about $1,900 by September 2011. Gold fell to about $103 on August 31, 1976, and later reached around $850 by January 1980. The March 19, 2026 low, near $4,557, has no completed ending yet. That part is unresolved, so the caveat is simple. Forced liquidation events can go further than you think. They can stay disorderly longer than you think. They can destroy leveraged holders who are directionally right. But the forensic record is still clear. A gold correction is often not telling you gold is unnecessary. It is telling you the system is selling its most liquid insurance to survive damage somewhere else. That leaves you with a binary choice. You can read the flare as an all clear, or you can recognize it for what it usually is, proof that the fire is spreading.